what their premiums were gonna be. Yes, they were in line, and they said, well, we'll give you a non-compete policy that was 3 times what I quoted. DTI was in the 60s. We had no chance. Right. The only other way was they had to bring more money for the down payment, which that's the roofing money, so that wouldn't have worked.
I know buying a house, there's 9 million things that you got to cover. But I think insurance should come up, or at least they should start getting quotes very early in the process. As soon, I think I said in the first episode or so, it's like right after the inspection. I think that the seed should be planted where they talk about insurance with me or whomever just before, like, hey, here's what's going on. I have the inspection in a couple weeks or a week out. Here's the scenario. House built in whatever the address is, 19, whatever. But at least lay the groundwork to start getting things ready and aligned after the inspection. I found this recently, a couple of days ago, where the woman reached out to me and said, hey, I'm having issues getting insurance on manufactured homes. Specifically, this one was in Rhode Island. She said, I need to get this quoted and presented to my LO by the 12th, which is today. And I said, what's the issue? What are you running into? Well, I need a policy. It's a VA loan. I need a policy that's going to be replacement cost coverage on a manufactured home. I can't seem to find one. It's very hard to. I actually couldn't help her. The point with this is that I don't want to nitpick or complain, but it's tough. It puts me into a really tough position, especially as it's handed off to me as a referral. They did some work on beforehand before coming to me. So I was the last line of defense here. They came to me, I already had quotes and I can't find it. I would have liked to talk to that person a little sooner in the process, because maybe I could have found that, took the time, do some digging, or at least hand off in another position, another way. Here, I can send you here. You can do this, and that. And I think too, especially when it's crunch time, you don't like it because you have a general idea of what to expect, or at least what you said. Hey, this is where the number should be, or based off of what I'm seeing in very similar situations, this is the estimate. And then let's just say assume that I was able to help her, but that estimate is 20% higher. Well, that kills the deal. So today in this episode, we're gonna really just kind of talk about insurance premiums that close the deal. And I'm actually really interested on your live reaction when this stuff happens. What is Colin thinking about when the agent? I haven't done that yet. I haven't hit you with. I can't help you yet. This one I haven't done that, but I'm really interested in that perspective and what the mindset is, and really the feeling of a loan officer. Like, as an agent, I always have this anxiety that I'm not presenting what is appetizing to my sources.
Right.
I want to help everybody, because if you win, I win. If the loan closes, everybody wins. Everybody's happy. The insurance rate's great. So I'm really curious on your perspective, and I send you something, this doesn't work. What's your immediate reaction?
Oh, no. No. So the immediate reaction is, and I this is how I look at it, Paul, is that I am the face of the home buyer's goal of buying the home. Whether it's from a referral partner that I got the lead, or I'm sending them to a referral partner too, any aspect of the transaction, for the purchase transaction, even for the refinance transaction, they're getting quotes, I feel that I'm the face. So as soon as there's I'll call it a speed bump with an insurance quote, or the appraisal value doesn't come in quite like we thought it would, any aspect of the deal pops up like that, I feel I probably put way too much weight on my shoulders, but I feel that I have to find a way to correct it.
Yeah.
To still make it happen. Is that always possible? You just said, that, from you couldn't do it. with that particular scenario. Someone out there probably could, but now they're under a time crunch, so that's even tougher. So being the face of it, my reaction in my head versus how I react to getting that news, and then how I have to express it to the client, or are you going to express it? And then when can I have the conversation about what we can do for next steps? I probably compartmentalize most of my reaction to say, okay, I still know that client is still looking to buy the home. They love the home. We can't go this route. What's the next 2 routes we can go in case that next one doesn't work? Because at that point, we can't put all our eggs in one more basket. We got to see what else is out there. Start making phone calls. And part of that, to the professionals listening, is that don't only have that one lender you go to, that one insurance agent. Have multiple. It's good to have multiple. I will not tell someone to say you should only have one person. You should, because industries change. I mean, how you can explain how much the insurance industry changes
in the last year.
I mean, the mortgage interest rate world since the pandemic. I mean, it got down into the 2s, and now we've actually reached 2023. We reached 8s. Like, that's a 6 percentage point swing. We haven't seen that in decades of mortgages. So having multiple resources as a professional is crucial for situations just like that.
Yeah.
So my reaction is, okay, who can I go in my Rolodex? Who can I call? And quite frankly, I know I can call you. You're going to do the very best you can do. But if it's something that you can't do, I know that you have contacts too. Yeah. So whether it's directly you or indirectly you, that's what I value as well. Yeah. From other spheres of influence, centers of influence. It's not just, I would love to do the work with them, but also I know that they have resources too, that they know what they can do and can't do. And the stuff they can't do, they know where it can go.
Right.
That is more invaluable to me and to the clients that I work with than anything else.
Obviously, this is probably, I'm curious on, as an agent, one of the things that I think is important to know, how do I put this without knowing their credit score? We don't ask them up front. We don't run their credit.
Right.
That's not something we do. But their credit score is attached to an insurance score. A lot of folks use Credit Karma these days. Or whether it's Equifax or TransUnion or whatever credit monitoring you have, there is a piece of that you can find your actual insurance score, which is indicative into how competitive your insurance rates are going to be. And one of the things that I wish, respectfully, right, is we were privy to a little bit of that information. Mm-hmm. Now, obviously, it's privacy, it's data, and all that stuff. So whether or not the client could reveal that to us, or it's coached like, hey, your insurance is also dictated by your credit score. Because this business, as you would know, and anything that you do in business or anything you do with relationships, is setting the proper expectation. Mm-hmm. And that is helpful for us as agents, and I think it's also helpful for you all to understand why this rate is what it is. Now, not every time you could have the perfect credit score and still not match up with that specific carrier. That does happen. It doesn't happen often, but it does happen. But I think that it would really give you the idea of like, okay, well, I get now why that is, because I feel like for the longest time, why these deals have gotten blown up by the insurance in prior to the relationship that you and I have created here was that, well, Paul's just has the highest rates all the time. Well, you're also sending me, X credit score customers. Mm-hmm. And I'm not sure if that was obvious to the lenders that I was dealing with at the time. Is that something that you were aware of, that their insurance score is attached to their social, that is one of the drivers to their insurance premiums?
I do know that. Now, how that information from the buyer gets relayed to you, I don't. Because I'm a firm believer of, I know my area of expertise.
Sure.
I know my field. That is your channel.
Right.
Now, what I can say is that when we do pull a client's credit report, like we are obligated to send them a risk-based performance page. It does go out. That does have information on there that they can share with you. It's at their discretion, but they can share that with you. You know, I talk to clients about their credit all the time. You know, we go over their scores, we go over the report, what it says and what it doesn't say and what it should say and stuff like that. So that's all a conversation I do have with the client. So it's interesting to hear your perspective of, you know, are clients just not telling you the numbers, or from the credit score perspective?
I just don't ask them, because so it's not necessarily, I'll say I have a good gauge of what I'm dealing with based off of the purchase price on the house. And I don't mean that in like any like biased way. I just have a general idea of like, all right, I'm dealing with like a good client. Now, here's the thing. Again, like I said earlier, I could still lose in those situations. I can run a quote and the house could be $3,000 and they could go down the street to X, Y, and Z agency and get it for, you know, $2,600. That's just a carrier piece. That's a carrier play. I know my carriers really well. I know what type of roof they want. I know how old the years of the roof they want. I know the interior quality that they're going to want to inspect the inside based off of the age of the house, or the exterior based off of certain criteria.
Yeah.
I know my carriers well. And anyone who gets into this business, you need to know your carriers well. I'd say this to my people all the time. If there's 3 things that you should know when it comes to how you operate and run your business. Do you know insurance? So do you know the basics we talked about last episode, coverage A, B, C, D,
Right.
you know that. Do you know what they're protecting? Can you talk to people? Yeah. All right. Yeah. Can you have a good dialogue with people and build relationship with somebody else? And then the third thing is, do you know systems? Do you know how to navigate through the systems, and do you know the carrier appetites? I would say those 3 things can protect the deal from blowing up, because blowing up the deal doesn't necessarily mean I have to close the deal. And we talk about the timing in previous episodes of getting that deal to me. If this comes to me sooner than later, I have the opportunity to hand off this deal to a different agent that I know, based off of, I know I can't help this person right now, right? So there's a lot of things that come into play on a premium base. How close is this house to the coast?
Right.
You know, some carriers will surcharge based off of the hurricane deductible, right? Surprise, surprise. You have a 2% or a 5% hurricane deductible. You usually see that on coastal properties, right?
Mhm.
So you go, you know, from I'm Shoreline, New London, East Lyme, Waterford, Mystic, Stonington, Pawcatuck, Westerly, all coastal properties, right?
Right.
They have a 2% or 5% hurricane deductible. Some carriers will surcharge for that. I've seen carriers surcharge as high as like $1,500 a year just to have a 2% hurricane deductible. Yeah, right? So those things are the surprises that come up in the discussion that
Right.
could potentially blow up the deal. Got to get these conversations started much earlier. Going back to, you know, because when you and I first met, and this sat with me, and I thought about it. You're like, yeah, I've gotten burned by insurance agents. Like, what do you mean got burnt? Is it mainly like someone over promising and under delivering their service and their pricing? I'm really curious on that piece.
Off the top of my head, I know there was a few instances where there was not favorable, you know, they couldn't do the insurance, and you know, it took 2 or 3 days to deliver that message to me.
Oh no, yeah, that's bad.
Because they were doing other research. Well, if you're doing other research that you already know you can't, that 2 or 3 days, like that message, if it was delivered like, hey, it's unlikely, I'm still trying, it's unlikely, but I'd like to give you the warning now to start to pursue other avenues, losing 48 to 72 hours. And, you know, more times than not, to your point, and I do believe it should be started sooner, but if it's the 48 or 72 hours in the last week of the closing, that's crucial time that I've now lost. Like, that's one thing that I can never buy back is time.
Right.
So, and then at that point, you know, the pressure's on. So that, and you know, going back to like on the face of the loan, whether I referred the individual to that insurance agent or it's their own insurance agents they're going through, I'm still the face of their loan getting approved. I'm still, trying to build, if I have a current relationship with their buyer's agent, I want to maintain that. I want to show my due diligence and still be able to be a referral partner to them.
Mm-hmm.
If it's a brand new realtor I've never worked with or a real estate agent I've never worked with, I want to show them why it'd be beneficial to work with me in the future. Even though it's an insurance aspect, I'm still the face. The first person that gets looked at of the loan not closing is me.
Yeah.
What other outside circumstances, it comes down to me as the loan officer, as a residential loan officer. So that's probably where I feel that, when I say I've been burned or I've had some bad luck, that's what I take out of it, is that I've lost a few relationships from loans not closing. And I'm not saying it was solely because of the insurance aspect,
but the transparency piece, right? Like being upfront, like, hey, Colin, like this isn't going to work.
Yep.
But they didn't rip the Band-Aid off. And that's what it boils down to, guys. And I don't know if I said this, I might have said this to you or somebody else on the podcast, but the biggest game changer in anything in my life, professional career, personal life, rip the Band-Aid off right away. It will do you. First of all, if you don't rip the Band-Aid off, let's just say I'm that agent. I didn't rip the Band off. That agent's in his head for 3 days trying to figure out how to rip the Band-Aid off.
Yeah.
You know what I mean? Like, until it comes to a point of like you reaching out. I'm sure you probably reached out to say, hey, where are we on this? Like, what's going on? Do you have a quote for me? And when you delay that process, you do yourself a disservice. This business is a credibility business.
Right.
How credible are you? Hey, Colin, listen, this is what you gave me. I'm going to be very honest with you. I think they could do better somewhere else. And what I was saying earlier was like, I know Hormozy or some of those guys who are really, in the game of business and really selling themselves. I'm okay with telling you that I can't help.
Right.
Because like at the end of the day, my relationship with you is more important. I am curious though, does it ever work where the insurance premium is higher than expected and pushes the limit of the DTI and still can close the loan, or no? Is it just like,
as long as we stay within the guidelines and
Yeah.
that client's still comfortable with that mortgage
Yeah.
payment perspective, at that point we're very, late in the game. Are you okay with the mortgage payment? If they've delayed and waited that long to get that, or it's taken that long to get the quote based on the home type or whatever it might be, at that point, the decision is not, oh, I'm going to go shop this again. It's
Right.
like, well, I'll take it now and maybe we have to shop again later. Like I'm not doing the bundle with the car, with the auto insurance.
Yeah.
Once I close, I'm going to have to do a complete reset.
Yeah.
I'm going to have to do a home auto and maybe some other policies to see if I can bring this down. But I am within guidelines. Can I save somewhere else to, it's $50 more a month than I thought it would be. Well, I can get rid of a subscription or whatever it might be. I won't spend $50 here, or I'll go to dinner one less time a month, whatever it might be. Can there be financial adjustments? Yes, absolutely.
Mhm.
Is that ideal? No. And I don't want to be the bearer of bad news to tell someone that. So the premium coming in higher, absolutely, it can still work. Is it ideal for the buyer's financial situation? They're going to be their first mindset is the numbers are the numbers. They want them to come in, if not like at the worst case scenario, they want the numbers to come in at that number.
Gotcha. So if you send me Jane Doe as a customer, hey Paul, here's the customer, here's the address, here's the loan amount. That's pretty much about the information you can give me, and I can get everything else from the client. When you estimate the cost of insurance, can you relay that to the agent? Like, hey, we need to be at $1,800 to $2,000. Is that something that you all can do?
Yeah, I mean, we can absolutely say, like, I can tell you, like, I estimated at this monthly amount, and this is what it would come out to annually. I truly, from my experience, and this is part of staying in touch with real, insurance agents, is that especially the last 3 years of the increases we've seen, knowing that in most cases it's a safe estimate to say somewhere between $1,500 and $1,800 is a conservative estimate for a home in like the $350 range.
Mm-hmm.
Once you get to above that, you're going higher. You may be even closer to $2,000 a year. So having that knowledge from an insurance agent, but that's basically saying the property's in good condition and the roof is not, pushing the thresholds. It's truly a conservative estimate. The person to talk to is Paul or the insurance agent they want to use. It's not ideal to be worrying about if the payment has gone higher do I still qualify?
How does and I often get this, especially when it's where customers are price shopping, $50 difference a year. I don't know if it's my job to communicate. Again, my job to communicate is my value. I'm never going to communicate on price. Like, I'll let you decide this is $50 cheaper and this is going to work within our budget. And I get it. Like I said last time, things are expensive. Gas is creeping down a little bit, but still, gas is expensive and food is, expensive. Everything, and you throw it under the umbrella, it's expensive, right?
Right.
But again, it's not your job to sell the policy. So this isn't anything I'll ever ask any LO to do. But I'm asking more so from the perspective of that consumer. How big of a deal, let's just say within the DTI, let's just say it's not pushing the limits of DTI. How big of a deal is it, the $50 difference on an annual basis? Is it not that big of a deal if it's $1,900 a year or $1,950 a year? Is it that big of a deal in the buyer scenario in like how they are looking at their expenses?
If the premium comes in $50?
$50 a year, not a month.
No, no, $50 a year because we're taking that number divided by 12.
Right.
So just to give you one example, a live example, Paul, was last year, it was a property being purchased in West Hartford. And, even in the listing photos, there was the roof was outdated. There was moss growth on it. And then there was tree overhang with, twigs on the roof right in the listing photos. And I'd given some names to contact for insurance. And luckily we started early on in the process because what ended up happening was the first two quotes that they got, they ran the numbers, showed them very good numbers, right in line with my estimates. And then they ended up looking at the photos of the property and they saw the roof. They saw the condition of the roof and they saw the photos of the twigs on there. And they went to their underwriters and the underwriters said, no, we will not write on this. We won't cover it. So I went to another referral partner. I explained what happened with the first two. Before even giving the client their information, I worked with this insurance agent and I said, what can you do? Before we even start to having the conversation, the client's already, got negative thoughts going on. So I got to be that face alone and see how I can,
build
come
that
to
confidence.
Yeah, exactly. Just, the speed bump, how do we get over it and keep going back onto flat road? And what ended up happening was the insurance agent, the referral partner said, look, we can do this here, but this is the only way we can. And it was basically they had to go into a roofing contract to replace within, it was either 90 or 120 days. I forget what the number of days it was, which the buyer had those funds saved up anyways. And they were going to do the roof regardless of this actually popping up anyways. But it came with certain parameters to meet not only the insurance need, but the mortgage need. So I explained this to the client. They were on board with it. They did their research. They had two, and it was great on their part because they made them the same day. They actually made them back-to-back appointments for two roofing companies to come out. So myself and the buyer agent were there because the buyer agent needs to know to explain to the listing side. But also I was there so I could explain the language and verbiage that was needed as part of the contract that had to be written in the contract before anyone signs it from the roofing company to the client. We were there for 3 hours. It was like June. It was so hot out. There was, ironically enough, where we were on the back deck, there was no overcast. The trees were all covering the front. So like sweating it out. And, we found the coverage. We found great in what they could do with the premium and then, ironically enough, when they rewrote the policy to say, oh, we're going to write it as a brand new roof as long as you, per the contract, complete the roof. And they had to send in photos and the certificate of completion and everything and close out the permit with the town. Did all that. I think the client did it in like the first 60 days, had it wrapped up. The premium was actually $100 less than what I estimated at originally.
Yeah.
No problem. Great. It worked out well. We got the quote. It actually helped out with their interest rate pricing. Client got a brand new roof. Very happy.
Wow. So I guess I never really thought about that the DTI limits pushes what their interest is going to be as well.
Yeah, so there is tiers when it comes to the DTI, and it can impact, that's not just credit score. The DTI does play a factor in from a mortgage lender's perspective of the interest rates we can offer. And, as you get, from 45, above 45% to 50 is a different, that's one tier, and then sub 45 and sub 40, those are different tiers of interest rates based on, then we look at the credit and all that. So yeah, it does play into it. And, but, it didn't kill the closing, but it certainly put a damper on the deal.
Yeah.
But we turned around. We actually still closed.
Yeah.
We still closed at the contracted date, and so we were happy with that too.
Yeah. And there's a thing I want to. I mean, this is not so more so the. I guess I mean the premium that closes that kills the closing. Also, potentially not being able to find insurance at all. The thing with the roofs, and listen. In 2023 2022 is when we started seeing like the change with insurance, and the roofs have to be 10 years, 15 years, 5 years. We're all sitting here like, what do you mean 10 years, 5 years, 15 years? That was just their way to try to slow down growth, because what was happening was that they were paying way more money out than they were bringing it in. So I totally get that. But from the perspective of an older roof that's approaching like the normal lifespan of shingles, 20, 25 years. Sometimes they say 30. There's not a lot of carriers that will write above 25 years. There's only a handful that I can think of that would do 25 years, and then there's another handful that would do 20 and under. Mm-hmm. But the thing about roofs is when I talk about it with a client is I need you to think about it from the insurance perspective. How much does a roof cost to replace? For a house, 1,800 square feet, 20 grand? 30 grand maybe?
It depends on the peaks and everything.
Yeah.
Round number, I would say 15 right off the bat.
15, okay.
I think 15 is a fair number,
Right.
And that's for a non-complex. I mean, there's going to be some peaks
Right.
and valleys, but nothing too crazy.
Right. And in the way the insurance companies, I think we're looking at it or are looking at it specifically as it gets later in life, the life cycle of a roof is it's more likely to have a loss of that amount, $15,000. So if you as a consumer are paying $1,500 or $2,000 a year on insurance, and you put out a claim a year later after buying that policy, who wins there? Well, I guess the insurance company does not win. The insured wins because they got a new roof. Talking points about the premiums, and we'll wrap up here in a few. There's a few things. There's replacement costs, which we've touched on, roof age and condition, which we're talking about right now, the credit score, insurance score where applicable, location, coastal exposure, flood, water risk, prior loss on property. We talked about that too a little bit. Companies will look at risk, and then companies will look at insured. If a risk, and I had this the other day, risk had $100,000 water claim. The company would not even entertain it, even though it wasn't their water claim. The claim happened 3 years before they bought the house. They wouldn't even look at it because it was $100,000. The company said, listen, if we're going to insure this, we need to make sure that the plumbing is all updated. Like $100,000, and the house was small. The house was only 1,200 square feet.
Wow.
So $100,000 is pretty sizable. So it makes sense why they don't want to do it without looking at it. But that is something. So there is risk that they look at, and then there's insured. So if you had a house before that you're buying a new house and you put a claim, you're likely going to get a surcharge on the new house. Most companies, again, on the risk side of things, don't penalize you for that, but there are a few. And then deductibles and endorsements. I leverage the deductible in a way when it comes to not blowing up the deal is self-retain as much as you're comfortable paying out of pocket. So, for example, if there is a tree that falls onto your house, what are you comfortable paying if you just had some normal damage to your house? So if you had $2,500 worth of damage to your house, you're going to use your $1,000 deductible? You shouldn't. Most people should use their insurance for catastrophic losses. So I say, if you're going to pay the $2,500 for the siding on your house or whatever it is, just make that your deductible because it brings down the premium. It helps the DTI, so hopefully it doesn't blow up the deal. And it looks better from the insurance perspective, my opinion, not financial advice. and then carrier appetite. Carrier appetite is a big thing in how premiums are assessed. Somebody would come to me from a X company and say, why is their insurance rate so high compared to this one? If you had uniform pricing across the industry, then there's just no market competitiveness,
Mhm.
right? There's just one insurance carrier then. So each carrier has their motto of what makes them profitable. And so you got to consider that too as well. And that's why an independent agent who has access to multiple carriers, not just one or two, that being 10, 15, 20, 30 carriers, that's important so it doesn't blow up the deal.
And another thing too, Paul, is in terms of when we're talking about the insurance premium, and we were talking about this in episode 4 about you can find stuff online. Another way you can find information, and you probably hear it a lot too from family, friends, neighbors telling you about what they did to buy their home.
Yeah.
They're probably going to tell you what they did for insurance purposes too, who
Yes.
they use for insurance. Take those recommendations, but still research on your own and find someone on your
Yes.
own too, because there are times where, I mean, you in episode 4, you had talked about, someone that wanted to stay with a carrier, even though they're going to pay a premium because of past service.
Mhm.
That might not be the same reason someone wants to work with that carrier.
Right.
That is a specific individual preference.
Yes.
So I think to wrap up in terms of the insurance premium killing a deal, and like I said it earlier, make sure you're contacting multiple parties, because that is crucial to have in your back pocket from a professional aspect. Clients, they want to work with just one, and that to each their own. I would recommend always getting a second opinion. But from a perspective of professionals in the real estate industry, whether it's insurance, mortgages, realtors, have multiple contacts, have multiple resources of information that can be given as education to that buyer or a homeowner from a refinance perspective. Have multiple sources.
And we'll go into it in episode 6, I believe, the things that we wish we knew early on. But I think that's just huge to talk about, like how we built that up, how we built up those referral sources. But the thing I want to touch on, and we'll wrap up on the insurance side of things, you just mentioned something that you see all the time on social media, in those forums, in those groups. I have X, Y, and Z insurance company, and my insurance rates are this, and they're like, oh, go to Geico, go to Progressive, go to State Farm. They offer me your neighbor's rates will never be your rates. That's just something we need to be very transparent about. You might get lucky and have the same $100 rate, $105 rate, but the factors that we've talked about almost every single episode now is not the same factors as your neighbor. You don't have the same car. You don't have the same credit. You don't have the same assets and liabilities and all that stuff that plays into the rating factors. So whenever I see that on social media, that it's like, all right, this company or that company, because they offer me better rates, it's such a misconception, which we talked about in episode 4. It is such a misconception that your rates are going to be uniform based off of what your neighbor pays. And that, if there's anything that bothers me the most, is just seeing and hearing that, because it's not the same. Could you imagine if, somebody came to you and said, oh yeah, someone so-and-so referred me, they got a 5% interest rate, whatever the interest rates are, 5% interest rate, and they said I can get that with you. Well, I mean, let's go through the process first, right? Don't skip the process. And skipping the process and cutting corners in general, whether it's as a consumer or as a professional, could lead into those deals that blow up the premium.
Yep. And I'm not saying that don't trust those individuals. Still,
Yeah.
That they're doing it because they come from a caring perspective, but they're not studying the ins and outs of insurance every day or mortgages, and they're seeing what they see.
Yeah, and I guess what I'm saying is for them to take the recommendation on the person, but not to take the recommendation on the rate.
Yes.
You know what I'm saying?
Yeah, absolutely.
Listen, I will refer you all day because you're a good guy. I know you're going to take care of this person, but I can't guarantee you that you're going to get the same rate that I got. You know what I'm saying? And I think that's what it boils down to. So guys, episode 5, we're rolling here. Episode 5 of the Handoff. Make sure you guys like, subscribe. I'm Paul Martinez with my co-host,
Colin Lacey.
and we'll catch you guys next time.